Today, we're doing something really practical, I think.
Yeah, definitely hands-on.
We're strapping in for a look at how you can navigate the U.S. stock market with, well, actual confidence.
Hopefully a lot more confidence.
Right. We're using the rule-based trading framework from seasoned trader Ryan Bolt as our source material here.
He's got some strong ideas.
Yeah, and the mission is basically to find those specific, concrete navigational charts he talks about, the ones that might help you turn market chaos into, real opportunity.
Okay, so where do we start?
Well, let's unpack this right away, because the first thing Bolt really hammers home is structure.
Right. And what's fascinating is how he defines the game. He says he doesn't really trade stocks.
Oh, what does he trade then?
He trades setups. A setup is just, well, a rule-based condition. Think of it like a checklist. A specific price pattern happens, and maybe a volume spike, and an indicator reads a certain way.
Okay, so it's a combination.
Exactly. It's designed to take the guesswork, the emotion, right out of it. You replace gut feelings with, well, hopefully, statistical probability.
And we definitely know why that structure matters. I mean, Bolt's pretty open about his own early days, right? Admits it was just chaos.
Oh, yeah. Brutally honest. Chasing Tesla because he just felt it was going up. Trading on hope, lost money.
But we've all maybe been there a little bit. It wasn't until he got this rigid, rule-based map that things started to click for him.
Exactly. And the power of the setup, the rule, is that it gives you a trigger that, ideally, you've tested. He points to the Apple recovery back in 2020 as a prime example of this kind of simplicity.
Okay, talk us through that one. What was the specific setup he saw there? Simple, you said.
Yeah, relatively simple. It was a classic moving average crossover setup, but, and this is key, with confirmation.
Confirmation being.
So June 8th, 2020, Apple's 50-day moving average crosses up decisively through the 200-day moving average. That's the pattern.
Okay, standard golden cross.
Right, but the rule wasn't just the cross. The rule demanded proof. Proof of institutional buying, commitment.
Ah, so how did he see that?
That proof came with a huge volume spike. 164 million shares traded right around that crossover point, near $82 a share.
Wow, that's significant volume.
It is. So you have the clear rule, the cross, plus the verifiable volume, green light. If you don't have both or all the pieces of your rule, you don't trade. That's the foundation.
That really shifts the whole mindset, doesn't it? From should I buy Apple to did Apple meet my specific criteria?
Precisely.
Okay, let's dig into the technical core of those criteria now. So the first cornerstone Bolt insists on, maybe the simplest, is trading with the trend. Sounds obvious, right?
Yeah.
But how does he pin down the trend technically? How do you make sure you're not just swimming upstream?
Yeah, trend following is like non-negotiable for him. It just tilts the odds in your favor from the start. He uses two main tools for the big picture trend.
Which?
The 50-week exponential moving average, the EMA that smooths out the weekly price action, and the average directional index, or ADX.
Okay, wait, ADX. That's a bit more specific. For anyone not familiar, what does ADX actually measure? Like in simple terms.
Think of ADX as the trend's engine power, its strength. It doesn't tell you if it's an uptrend or downtrend.
Just how strong the current trend is, whichever way it's going.
Exactly. And the key rules are straightforward. For long trades, you want the price above the 50-week EMA, confirming the uptrend direction. And importantly, the ADX needs to be above 25.
25. That specific level matters.
He finds it critical, yeah. It suggests there's enough momentum, enough conviction to carry a move further, makes it more likely to be profitable.
So conversely, if ADX is, say, below 20, what then?
Avoid it. Just stay away. Below 20 usually means a choppy, sideways market, grinding action. And that's where traders tend to get chewed up, lose money on small, meaningless moves. It's a filter.
An essential filter, sounds like.
Invaluable. Look at his Tesla trade example from 2021.
All right, I remember this one. It shows patience, not just jumping in.
Exactly. Tesla was clearly in a strong uptrend. Confirmed by the EMA, ADX was strong. But Bolt didn't just buy anywhere.
He waited.
He waited. On September 21st, 2021, the setup only triggered when the stock pulled back cleanly to the 50-day EMA. It closed there at $739.38.
In the specific signal.
The entry signal was a hammer candlestick pattern forming right at that moving average support level. That shows buyers stepping in aggressively right there.
So the rule was strong trend, pull back to support, then a confirmation pattern.
Bingo. Following that precise sequence yielded, I think it was about a 7% gain fairly quickly, no chasing involved.
Okay, so trend puts us on the right side of the market, but timing is still crucial. Bolt emphasizes that. How does he use momentum indicators for, nailing down the entry and maybe the exit too?
Right, that brings us to momentum, capturing market enthusiasm, as he puts it. If the trend is the big ocean current, momentum is like the strength of the waves right now.
Okay, I like that analogy. What tools?
Here we look at oscillators, primarily the relative strength index, RSI, and the moving average convergence divergence, MED.
Let's talk about that AMD trade in 2023.
Yeah.
It seems a little counterintuitive, maybe. Why look for an RSI divergence if you're trying to follow the trend?
That's a great question. It shows the nuance, right? It's not always just buy when strong. In that AMD trade, June 5th, 2023, the stock closed around $170.
Uh-huh.
Now, the price was generally selling off, making lower lows. But crucially, the RSI indicator was making higher lows.
Okay, so price down, indicator starting to hook up. What is that signal?
That divergence suggests that the selling pressure, the momentum behind the selling, is fading. Sellers are getting exhausted even if the price hasn't turned up yet.
Interesting. So it's a potential early warning of a turn.
Exactly. And when that RSI divergence was confirmed by a bullish engulfing candlestick pattern right at a known support level, well, that became a high probability reversal entry signal. Led to a 9% gain, I believe.
That takes serious discipline, though. You have to trust the indicator divergence even when the price looks like it's still weak.
Absolutely. Trust the system over your gut feeling. And the reverse is true, too. He talks about a failed Microsoft trade where he ignored the MACD.
What happened there?
The MACD was showing momentum weakening, diverging bearishly. Even as the price was still kind of inching higher, he didn't heed the warning, held on too long. So these indicators are vital for exits or staying out, too.
Right, not just for getting in. Okay, speaking of validation, let's begin volume and volatility. The market's pulse, you called it. Volume as the lie detector.
Perfect way to put it. Volume confirms if a price move is genuine or just, noise. Bolt really stresses this. Volume must confirm price action.
Example.
If a stock breaks above a key resistance level, a price ceiling, but does it on really low, pathetic volume.
Nobody's buying into the breakout.
Right. Nobody really cares. That breakout is much more likely to fail, to be a fake out. It's a trap.
Okay, and volatility, how does that fit in?
Volatility tells you about the risk, the potential size of the swings. He uses tools like Bollinger Bands for this. Are the bands wide, indicating high volatility and risk, or narrow and tight?
And we saw the volume confirmation play out really well with Microsoft in 2023, didn't we?
Yeah, the Microsoft breakout on July 17th, stock moved decisively above $340 resistance. That's the setup pattern.
But the key was?
The key was the volume. It spiked to 1.5 times the average daily volume on that breakout day.
So big money was interested, institutions jumping in.
That's the interpretation. That huge volume-confirmed commitment made the move much more likely to be sustainable, and it led to, I think, a 7% gain. The rule is crystal clear. See a breakout on weak, low volume. Assume it's a trap. Avoid it.
Okay, so we've got the big trend, we've checked momentum, we've confirmed with volume. Now we get into precision, right? Pinpointing the actual entry using candlestick psychology. I love candlesticks. They visually tell a story.
They really do. Each candle is like a mini battle report between buyers and sellers for that time period. Take the 2022 Apple trade example on March 15th.
What happened there?
Apple had sold off pretty hard, but then right at a solid support level around $150, the daily candle formed a perfect hammer pattern.
Okay, a hammer. Remind us what that signals visually.
A hammer has a long lower shadow and a small body near the top of the candle's range. It means sellers pushed the price way down during the day.
Right.
But buyers stormed back in, overwhelmed the sellers, and pushed the closing price right back up near the high for the day. It's a visual sign of strong rejection of those lower prices.
A potential bottoming signal.
Exactly. And in that Apple case, it signaled the start of a rally that eventually went up near $180.
But these patterns, hammers, dojis, and they can pop up randomly sometimes. How do you filter out the noise? How did Bolt know that hammer was significant?
Layers again. Discipline. Bolt is adamant for a candlestick pattern, especially a reversal signal like a hammer, to be considered high probability.
There's a volume rule.
You guessed it. It must occur on volume that's greater than 1.5 times the recent average volume.
So again, confirmation through commitment. The story told by the candle shape needs to be backed by significant buying or selling pressure.
Precisely. That rule filters out the random, meaningless patterns and focuses you on the ones with real conviction behind them.
Okay, this idea of layering signals, confirmation, it leads perfectly into the next critical step, multi-time frame analysis. Now, for someone starting out, this might sound like making things way too complicated, checking 3 charts instead of 1. Why is looking at weekly, daily and hourly charts so essential?
It sounds like more work, but it's actually about reducing risk and increasing edge. Think of it like using GPS with different zoom levels.
Okay, how so?
If you only look at a short-term chart, say an hourly chart, you might see what looks like a great buy signal on a dip.
Right, looks like a bargain.
But if you zoom out to the weekly chart, you might realize that dip is actually just a small pause in a massive, powerful downtrend. You'd be buying right into the path of the falling knife.
Catching a falling knife.
Yeah.
Bad idea.
Terrible idea. So the multi-time frame approach ensures you're aligned with the dominant forces on all levels. It layers the analysis for safety.
So what's the hierarchy he uses? Which time frame dictates what?
It's a clear system. The weekly chart sets the overall context, the big picture trend. You only consider trades in the direction of the weekly trend. No counter-trend heroics.
Got it. Weekly's the boss, then.
The daily chart is where you identify the specific setup we've been talking about, the moving average cross, the Bollinger Band breakout, the hammer pattern at support, whatever your rule is.
Okay, so weekly for direction, daily for the setup pattern. What about the hourly?
The hourly chart is used purely for timing the entry, fine-tuning it, looking for that precise, low-risk moment to pull the trigger after the weekly and daily charts have given the green light.
The payoff for that layered discipline must be significant when it all lines up.
Huge. Look at the 2023 NVIDIA trade example. That resulted in a 7% gain, and Bolt attributes it directly to that perfect confluence across timeframes.
How'd it line up?
The weekly chart showed a clear, strong uptrend. No question about the direction. The daily chart presented the specific setup, a Bollinger Band breakout, price pushing outside the band, and then the hourly chart provided the precise entry trigger with a bullish MACD crossover signal.
Weekly, daily, hourly, all singing the same tune.
Exactly. And he warns, from painful experience like a messy 2022 Apple trade he mentions, that failing to check that higher time frame context, especially the weekly, is probably the fastest way to step right into a losing trade, a trap.
So the overarching strategy here is what he calls stacking probabilities. It's not about finding one magic bullet indicator.
No, definitely not.
It's about combining 2, 3, maybe more reliable signals that all point the same way. He suggests that combining just 3 solid signals can potentially boost win rates significantly, maybe into the 60 or 70% range.
Yeah, it's about turning trading from what feels like a coin flip, a 50-50 guess, into something where you have a quantifiable statistical edge over time. It's math, not magic.
Okay, we can talk technical setups all day long, but Bolt is incredibly clear on this point. You absolutely have to survive long enough in the market to even use them. Risk management is non-negotiable.
It's survival first, profit second, always.
He talks about a really painful loss he took on Facebook back in 2019. A 15% hit overnight. Ouch. And it was purely down to bad position sizing.
Okay.
Greed took over.
That story is crucial. It shows that even if you have the best setup recognition in the world, if you bet the farm on one trade and it goes wrong, you're out of the game.
So what's the core rule for survival?
His foundational, absolutely unbreakable rule is risk no more than 1% of your total trading capital on any single trade.
1%, that sounds small.
It sounds small, but it's incredibly powerful. It forces you into precise position sizing. It mathematically guarantees that one bad trade or even a string of bad trades cannot wipe you out. You live to trade another day.
Okay, let's make that concrete. If I have, say, a $10,000 account, 1% risk means I can only afford to lose $100 on any given trade. How do I translate that $100 into how many shares I buy?
Good question. First, you determine your stop-loss placement based on the chart, based on technical logic.
Not based on how much you want to lose.
No, never. The stop-loss goes where it logically should go, maybe just below a key support level, or perhaps using a volatility measure like the average true range, the ATR.
ATR measures the stock's typical daily movement.
Yeah, exactly. So it helps set a realistic stop. Once you know where your stop needs to be, let's say it's $5 below your entry price per share, then you calculate your position size.
Yep.
You simply divide your maximum dollar risk, $100 in our example, by your per share risk, $5. So $100 divided by $5 equals 20 shares. That's your position size. Buy 20 shares, and if your $5 stop gets hit, you lose exactly $100. You're planned 1% risk.
That makes the whole sizing process completely mechanical. Takes the emotion out of deciding how big to trade.
Precisely. And it's not just about limiting losses. He also emphasizes using trailing stops to protect profits once a trade moves in your favor.
Right, locking in gains. How does that work?
It's essential for maximizing winners. Using that 2023 NVIDIA example again. Maybe you entered at $285 with an initial stop at $275, risking $10 per share. As the stock climbs to, say, $310, you might trail your stop up to $300.
So you've locked in $15 of profit per share minimum.
Exactly. You're guaranteeing you don't let a winning trade turn back into a loser. It's about surviving and thriving.
Okay, so risk management is like the body armor of trading. But Bolt says psychology is the heart. This is where apparently 90% of traders fail, not because they can't read a chart,
but because they fall victim to their own minds, emotional traps.
This feels like the most critical part, maybe the hardest part. Why do smart, analytical people struggle so much here?
Because we're human. Bolt points to common cognitive biases, things like anchoring, getting fixated on a past price, like, I bought it at $50, I'll only sell if it gets back there, or overconfidence after a winning streak.
Been there.
We all have. But the real account killers are the raw emotions: fear, greed, hope, especially hope when a trade is going against you.
He tells a great story, a relatable mistake about Apple in 2022. Shows fear in action.
Oh yeah, it's a perfect example of emotion overriding a good plan. He had a valid setup on Apple, things were looking good, but then the overall market got a bit shaky.
He got spooked.
Fear took over, he bailed out, sold his shares at $158, basically getting stopped out by his own anxiety.
And then what happened?
And then he had to watch as Apple immediately turned around and rallied straight up to his original price target near $180. He had the analysis right, but let fear dictate the action. Costly mistake.
Oof. So what's the fix? You can't just surgically remove fear or greed.
No, you can't eliminate the feelings, but you can build systems and habits that help you manage them, that override the impulse. Bolt's main tools here are practical.
Like what?
2 key things: meticulous journaling and using pre-trade rituals or checklists.
Journaling, like writing down every trade.
Yes, but more than just the entry and exit prices. Why did you take the trade? What was the setup? What were you feeling? Why did you exit? Did you follow your rules? This forces objective self-assessment.
Data over drama.
Exactly. This is how you actually prove to yourself whether your system works. Is your win rate really 50%, 60%? What's your average win versus your average loss? It takes trading out of the realm of random feeling and into data analysis.
And the pre-trade ritual.
Just a simple checklist before you click the button. Is the trend confirmed? Is volume there? Is my stop set? Is my position size correct? It forces a pause, engages the logical brain before the emotional brain can hijack the process.
And he has that disciplined 2023 Microsoft trade netting 4.5% as the counterexample, right? Where the rules were just executed, overriding any noise.
Precisely. That trade shows the system working as intended, rules followed, emotions managed, planned, profit target hit. If your journal confirms your system has a positive expectancy, meaning over time it makes more money than it loses, then your job is just to execute the rules flawlessly. Let the math work for you over many trades.
Okay, so we've assembled all the components. The technical tools for finding setups, the risk management for survival, the psychological tools for discipline. The synthesis now is about putting it all together consistently. Repeatability.
That's the goal. The complete system isn't just a collection of tools. It's an integrated 5-step action plan, a loop you follow every single time.
Okay, what are the 5 steps in his integrated system?
All right, step 1. Identify potential high-probability setups using your defined rules for trend, momentum, and volume. Scan for those conditions.
Step 2.
Confirm confluence. Does the setup align across multiple indicators? Critically, does it align across timeframes, weekly, daily, hourly? Get that layered confirmation.
Step 3, the entry.
Time the entry precisely. Use that lowest time frame chart, maybe the hourly, and specific candlestick patterns or short-term signals to pinpoint the lowest risk entry point after steps 1 and 2 are green.
Step 4, the essential one.
Manage risk religiously. Apply that 1% max risk rule. Calculate the correct position size based on your technically sound stop-loss placement, no exceptions.
And finally, step 5, the feedback loop.
Review performance. Meticulously journal every trade. Track your key metrics: win rate, risk-reward ratio, and, crucially, your overall system expectancy. Is it mathematically positive? If not, what needs adjusting?
That cycle of execution and review seems vital.
It's everything. It's how you refine the system and build trust in it.
And that final system example, the 2023 NVIDIA trade, really ties it all together, showing the structure in action.
It does. It's a perfect illustration. Entry at $131. Stop loss automatically calculated and placed at $126 based on the 1% rule and chart structure.
Confirmation.
Confirmed by the weekly uptrend, confirmed by daily momentum indicators like MACD, confirmed by volume. All boxes ticked according to the system.
And the result?
The resulting 7% gain wasn't luck, it wasn't a guess. It was presented as the logical, data-driven outcome of just executing the 5 steps, flawlessly following the complete system. Hashtag tag tag outro.
So I think the ultimate takeaway here for you, the listener, is that this kind of framework offers a really practical, data-driven path. It uses verifiable examples from major U.S. stocks, Tesla, NVIDIA, Apple, Microsoft, that you can actually go back and look at on a chart yourself.
See it for yourself.
And crucially, it puts just as much emphasis on the psychological discipline, the risk management, as it does on the technical indicators. The structure becomes your shield against those emotional pitfalls.
Absolutely. You know, the journey from feeling lost in market chaos to achieving some consistency, it really does seem to rely entirely on practicing these kinds of defined setups over and over.
And using that journal.
And using the journal, allowing those inevitable losses, because there will be losses to become invaluable, learned lessons, not just painful experiences. The foundation of Bolt's system seems to be understanding the trend first. So maybe a final thought to leave you with. Which of these core technical concepts we discuss, trend, momentum, volume, volatility, or candlestick patterns, which one stands out most to you right now as maybe the best starting point for your own exploration? Where might you begin building your very first trading rule?
That's definitely where the real deep dive begins for each person. Great stuff. Thanks for joining us.